Welcome to a presentation discussing deflation and gold. And I've put in the title, The Surprising Performance of Gold in Deflation. And the reason why I've done that is because I think a lot of people would say if inflation is good for gold prices, then deflation must be bad by default. But that's not what the history shows us. And I'll be presenting some evidence to that effect in this presentation. And this presentation is brought to you by Orionum, which is a UK bullion bar and coin company. The reason why I like Orionum is there's a lot of free resources on the website, including this map that you see on screen. So this, if you go to their website, you will see a live version of this map where countries are changing color depending on how their currency is performing against the gold spot price. So that's really good for seeing events in some of the smaller countries. And also there's a free page PDF document that you can download, which is a market report, which shows you how gold prices and silver and platinum prices have performed against other commodities and what's going on in the market. So they're really good to download as well. I'm going to start off by defining deflation because depending on what school of economics you describe to, there's actually two sort of differing definitions. And one is based on the contraction of the money supply, and the other relates to falling prices. And I'm actually going to use the latter here. So I'm going to talk about, whenever I mention deflation, I'm talking about falling prices. Deflation is actually quite rare and in modern times, and I think the main reason for that is because central banks have been increasing the money supply over time. I was born in the 80s, and I remember in the 90s what £5 could buy you, and now it's completely different. £5 is nothing. And the reason for that is that they've increased the money supply and it's debased the currency. But contrary to market consensus, gold prices have actually done very well historically during periods of deflation, which by definition is falling commodity prices. Now, credit where it's due. A lot of or nearly every piece of information from this presentation is taken out of a book called The Golden Constant. And it's quite an old book. It's a very expensive book. It's rare, so it's over £120 to buy. So I've read a few sections in the book, and I've got some information so that if you don't want to purchase the book, you can still benefit from it. This graph is actually taken from the book, and so basically what this shows us is going back to the 15th century. The yellow curve is the gold spot price, and what you are seeing is the commodity price or basket of commodities, and you're also seeing the purchasing power of gold. So this is what this is showing, and on the graph I've taken the liberty of putting some purple boxes on to show periods where commodity prices were falling, which caused deflation in the economy. And we're going to look at each of these boxes in a granular detail, and you can see that the graph continues. So there's a couple more sections here that we're going to look at. So you may have seen on that graph that there was actually four periods of deflation. Three were after 1800, and they were the most severe. But in all four periods of deflation, gold prices performed well, relatively speaking. And here we have, so in a 13-year period from 1920 to 1933, just by holding gold, you would have increased your wealth by 2.5 times. So when you look at what you could buy when you sell your gold, over that period you would be able to buy 2.5 times more at the end of the period. So 1813 to 1815, this was the worst deflation that the UK or England had endured in terms of depth and also duration. Agricultural prices fell and the manufacturing industry basically saw a wave of failures. Money tightened and gold went to a record premium. So you can see here that commodity prices fell 58% and the purchasing power of gold went up by 70%. So for those of you that are unfamiliar with some of these terms, purchasing power of gold means that what can my gold be exchanged for? If during the period I can buy 10 items, but at the end of the period I can buy 13 items, then purchasing power of that gold has gone up because it can be exchanged for more. So what you'll notice on here is the thick black line is the gold spot price. It didn't really go up, it just held its value whilst everything else was losing value. So relatively, in relative terms, gold was appreciating against other falling assets, which in this instance is commodities. 1873 to 1896. So prices actually bottomed in 1896 and the gold price was remarkably stable through the period. A hoard of gold could be exchanged for about 80% more commodities in 1896 than 20 years earlier. And you can see here that commodity prices fell by nearly a half over that period in time. And just by staying constant, and this is where I think they decided to call the book The Golden Constant, because it holds its value throughout time when other things don't hold their value so well. And you can see that the gold basically flatlined while everything else was taking a bath. So purchasing power of gold actually went up by 82%, meaning obviously that gold could buy 82% more at the end of the period than at the beginning. So the 1920s, Europe actually had, obviously in the US, 1929 is famous for the Great Depression onset, but Europe actually had its own version of the Great Depression in 1920, and you can see that commodity prices fell 69%, which is a massive move, but gold prices went up by 251% in that same period. And gold fell as commodity prices declined, but done so at a slower pace. So you can actually see that what you're seeing on the screen, I know it's hard to see because it's actually taken from a PDF, but the gold price did actually fall. But again, it fell at a much slower speed relative to commodities. So it held its value quite well when commodities were just hemorrhaging price. And you can see on here that and this is actually something that happened as well, because prices were almost constant for gold in the 17th century. So for the better part of a century, gold prices were flat. And the purchasing power of the gold was effectively flat over that time period. So it where it started and where it ended was there wasn't much movement. There was a lot of volatility in between, but when you take 2 points, 17th century to the end of the 17th century, what gold could buy didn't really change at the end relative to the beginning. And there is actually 3 cycles, so 3 boom and bust cycles in commodity prices. So what you can see on this graph is that the purchasing power of gold is a complete opposite to commodity prices. So when commodity prices go up, purchasing power of gold by default goes down, and the converse also holds on the way back up. So just to wrap up, gold is a store of value, as we know. As a gold investor, you know that. But gold has shown over time that it holds its value very well over a long period. But interestingly, this is not because gold moves towards commodity prices, but more because commodity prices fall back in line with the gold price. And I mean, this is being filmed in summer 2022. And what I'm seeing a lot of is people saying that why are commodity prices going up, but the gold price isn't? And what we've seen over for 3 centuries, gold has been like a magnet for commodity prices, with commodity prices reverting back to the price of gold rather than gold going up or down wherever the commodity prices have gone. So what I expect to see as a forecast is that commodity prices will come back in line with gold, and then perhaps we'll get our next move in the gold spot price.